very poorly. Again, it gets back to the point of what's the message of the gold market? I don't know. I'm not concerned. Cause, to me, is a lot less important than effect. So we look at the precious metals complex. The leadership is still there in the whites. Gold, silver still heading to the downside. And the gold market, at the end of the day, has done nothing wrong. We know how gold tops. We've seen it in the 70s. You tend to have an explosive move to the top side where everybody's in. When Time magazine has the cover saying, the gold rush, then we know it's time to fade. But it's still not there yet. So we're bullish the gold market. I won't tell you my ultimate target, because if I told you my ultimate target, I swear you'd take me off in a straitjacket. But we still think gold has a lot further to go.
It's amazing you mentioned the cover. I have a lot of covers that I kept of people that are not even with us, but they're behind bars somewhere. So definitely, it's not a good thing to be on any cover.
When we look at commodities, we, generally speaking, and relate that to how they affect our markets, the bulk of our markets have certainly been helped by the good commodity cycle. And so, our expectation, it really hasn't changed all that much. We do still expect, just because of the additional demand of a lot of these emerging economies, we do expect commodities to continue to rise.
I'm always hesitant about talking or writing about gold, because I wrote an article about gold about 4 or 5 years ago, and I received an email from a gentleman in America who disagreed with my view and described me as an arsewipe, and I thought that was a little inappropriate. So I tried to avoid talking about gold ever since, but if I may talk about gold and hope that you won't call me that particular word, I'll just make one particular observation, which is that in a world of monetary experimentation, in a world where people worry about central banks doing crazy things, gold is something which provides a lot of safety. I'd also note that if you look at institutional investors and how much gold they own, it's tiny. They don't really treat it properly as an asset class as yet. So I suspect that I'd probably agree with Jordan in terms of the sort of targets we have in mind, that over the next few years you can imagine gold prices being significantly higher than they are today.
Let me bring it to foreign exchange just for a sec, because it's related. What you tend to be having in the FX market, it seems to be what we're calling the ugly pageant. Who can debase their currency more? Who can devalue their currency more as a way of getting out of the economies? Well, the last time we saw that was in the 1930s. And at that time, everybody was competitively devaluing their currency. And at that time, gold was up 89%. So as long as you have this kind of vol in FX or this uncertainty out there, then that's going to keep an underlying bid to the gold market as well.
Good. So moving over a little bit of the stock market, a couple of questions related to that. So one of them is, who is behind the market rally, given the decline in volume to domestic mutual funds assets, I guess, on the management? And does this condition increase the risk for another crash? I have no idea who's behind it. Usually, you get a lot of kind of a hedge fund activity that sometimes pushes things to the extremes. So I think it's really hard to get a handle on a day-to-day basis. My best guess is that assets and equities were surely underallocated, and as some of the winds blew over in November and uncertainties on the tax front went away, I think a lot of money started coming back in the marketplace, and I think on a day-to-day basis you see earnings coming out and shorts get covered. But I think on the fundamental front, whether it increases the risk of another crash with volume being thin, I'm not too sure about that. I don't know if any of you have comments on it.
Well, I would just say that our equity strategists think that valuations are perfectly okay at the moment, but then whenever I ask our equity strategists, what do you think of valuations, they always tell me they're okay, because they're equity strategists and they tend to like to think that markets always go up. One thing I would say, though, is that if I'm right about this whole business of rising inflation but without much in the way of rising output, if the split between the inflation and output deteriorates and at the same time people fear higher interest rates, that is not really a great combination for equities longer term. And if you think about the situation back in 1987, at the beginning of that year, things looked pretty good, the recovery was coming through, but as the year progressed, the dollar got weaker and weaker, people got worried about rising interest rates, the Germans threatened to raise interest rates, actually did by August of that year, and it wasn't long after that we had a fairly nasty stock market crash. I'm not predicting that for this year, but I do think there are a number of financial uncertainties out there which might suggest that this current rally may not last for much longer.
Mm-hmm.
You're really going to hate me after this one. Valuations. Okay. I think when someone says this is a compelling value right here, you should run for the hills. No disrespect, I know valuations matter, but they're never going to help you buy and sell or profit. Enron, pretty compelling valuations all the way down. If you're from Canada, you know Nortel, pretty compelling from 100 down to 2. If you really follow commodities in Canada, we have a great story out there called Bre-X. I don't know if any of you know the Bre-X story. So valuations always look compelling all the way down. We work at Barclays. I mean, we know some banks had some challenges a couple of years ago, and the valuations were pretty compelling all the way down there as well. So it's not that valuations don't matter, but I'm not sure they're going to help you with your buy, sell, or hold decisions. As for market crashes, look, market crashes don't happen in a vacuum. They don't happen all of a sudden. The history of a stock market, again, is that it takes time to top out. What would you look for? Let's say real time, the market is going to crash next month. What are the signs that, based on history, 9 times out of 10 you see before a market crash? The first one you see is a deterioration in breadth, the internals of the stock market. There is no, I'm assuming most of you have equity exposure or interest in equities. There is nothing more important to understanding the equity market than understanding the internals. I won't go too much into it, but it's like taking an x-ray of the stock market to see if it's healthy. That's where you hear about volume, upside, downside, advanced declines. For example, the advanced decline line tends to top out before a market turns to the downside. So number one, the internals deteriorate despite the fact that the market looks healthy from the outside. And what else do you see before a market crashes? Sector rotation. What is outperforming and when matters a great deal. So is healthcare starting to outperform? Are the staples outperforming discretionary? Energy's been an outperformer, so has tech. Is that what you see in a bull market? Not at this part of the cycle. So you watch for sector rotation. You certainly watch for the internals. That's the warning signs you tend to see. Not always. Market's never going to make it that easy, but 80 to 90% of the time it's going to tell you that. And remember one last thing. It hasn't come up that we're in the third year of the presidential cycle. There's economic cycles, there's market cycles, but since 1939, you have not had a down year in the presidential cycle. 17 third years in a row to the top side. The average, the median move in the third year of a presidential cycle is 15 to 16% versus 7% in the rest of the cycle. So we're in a good cyclical time. Breadth looks fine, and energy and technology, materials and infrastructure are doing well, so the sector rotation is there. Those start to deteriorate, you start to get worried. But as long as those are stable, which they are, then the market is still on a decent footing.
All right, now we're going to get down to specifics. Luz, there was a nice commentary question for you, congratulating you on your returns and what you're doing. But the bottom line was, what 3 countries are the ones that you most bullish on?
We have our heaviest allocation to Russia, Brazil, and Mexico, part of the BRIC countries. No surprise. Primarily, and I would say the story behind that is because those are the markets that have the heaviest issuers in terms of the emerging corporate sector. There's a larger breadth of issuers there, and as a result, we find companies that have issued with attractive valuations and very good underlying credit fundamentals.
All right, so since I know we're running short on time, so one question is a good one. If you had $1 million to invest, or 100, or $1 billion, or $1 trillion, as the Fed has, what would you do with it? If you can't forecast and you have money to invest, what would you do with it to protect it and to get growth?
Me?
Any one of you.
Well, I'm from Toronto. I'd buy the lease.
I will tell you that for my personal money, I have a very unusual asset allocation, and it will probably come as no surprise to you that I'm invested in emerging market debt.
I would pay off my own debts, and I think that I would certainly invest in the emerging world, but I would think of interesting angles in which to do it. So you might buy some developed companies which happen to have lots of emerging market exposure. And I might also be still tempted to buy some commodities, because if the emerging market story is true, then the pressure on scarce resources will become ever more intense in the years ahead.
Just quickly on a serious note, break-evens, number 1. Number 2, exposure to India, because I think it's the best-looking term out there, and definitely have some exposure to gold.
I think we're going to only answer a couple more questions that we have here. And I think the question for all of you is, what is the black swan, or the biggest risk that investors are missing on?
Can I answer this?
Right,
because I was at a conference a couple of years back, and Nicholas Taleb was there at the conference, and he was sort of going around saying, I forecast the crisis. And I said, well, how could you have done? Because it was a black swan, and therefore, by definition, you couldn't forecast it. The tricky thing with black swans is, of course, by definition, you can't know what they are until they actually have happened. So that's really my answer. I don't have a black swan because, by definition, they don't. Can't be forecast.
That's right. I think, one issue that has been in the headlines a lot has been all about underfunded pension liabilities and repercussions from that. And knowing where I am, I know the subject is a very hot one over here. So I think the question is about what Meredith Whitney said a couple of weeks